The cost of living will double in 10 years. In this episode, I'm going to address inflation alert. Cost of living to go up significantly, and I'll prove to you what's happening and what caused it to happen. So, my name's Doug Andrew, and I've helped people optimize their financial assets and minimize taxes for more than 4.5 decades. So, I've watched a lot of periods of time where inflation has eroded away the purchasing power of those dollars, those hard-earned dollars that people save and sock away for goals like retirement. In fact, taxes and inflation are the two biggest reasons why retirees outlive their money. So for 4.5 decades, I've helped people become immune from taxes going up and from inflation. I don't like inflation any more than you probably do, but it doesn't hurt me. It actually helps me. So let me explain why we're headed for significant inflation, what causes it, and then I'm going to come back full circle and share with you what you can do to hedge against inflation and protect yourself from the purchasing power of the dollar being cut in half about every 10 years, or in other words, the cost of living doubling every 10 years. So why does this even happen? When we have a lot of government spending, and I think a lot of people can see that the government has been spending way more than they bring in. For example, usually as of the recording of this episode, the budget for the federal government has been approximately $5 trillion. So the IRS tries to collect $5 trillion. So sometimes spend it before they bring it in, but they're always trying to balance this thing so that they bring in $5 trillion of revenue to cover the $5 trillion that is being spent. Well, because of COVID-19 and the pandemic and so forth, a lot of stimulus packages were passed, and then also another relief bill, and now another infrastructure bill, and they're trying to spend money like crazy. To be honest with you, they are spending more than double what they bring in. So they have to raise taxes or do what? Print money. And sometimes that's what happens in governments across the world. We see that anytime a country, to cover their spending, when they spend more than they bring in, if they try to solve it by printing money, it has never, ever turned out good. Show me one time it has ever turned out good. And so I'm concerned. And this is why inflation is going to be significant, because when you fill the economy full of a bunch of printed money, that causes the dollar to become worth less. Goods and services cost more. You get less bang for your buck and so forth. And that's called inflation. The cost of living goes up. Now, to be honest, for about the last decade or more, the government changed the way they calculate inflation. They used to say, from year to year, okay, these goods and these services, how much did they go up in price? And they used to say a filet mignon, an 8-ounce filet mignon is compared to an 8-ounce filet mignon a year later. Now they reserve the right to say, well, an 8-ounce filet mignon, we can show hamburger instead of a filet because it's still red meat. What? No. And so sometimes the way they report the inflation rate is really skewed. Now, that was just an example of how ridiculous it is, the way sometimes they report inflation and the cost of living. So they've been trying to hold it down, thinking, oh, inflation, it's only been 2 or 3%. Okay. Well, again, there's a lot of Americans that if inflation is 3%, they have their money in the bank or credit union earning less than 1. So what does that mean? You're rowing upstream, so to speak, at 1 mile an hour, 1% interest, while the current of inflation is coming down at 3 miles an hour, 3%. Which way are you going? You're going backwards, okay? You are losing purchasing power. That's the danger of inflation. Now, how do you calculate what inflation will do to the purchasing power of the dollar or the cost of living when it goes to 5% or 10%? because there's a lot of goods and services like healthcare costs, prescriptions, and so forth, where the inflation rate is 7, 10%, even 15%. I remember back in the 1980s, we had double-digit inflation. But I'm going to make a statement here and prove it to you. Because of a strategy I've used for years, and I'm going to gift you a copy of my most recent best-selling book at the end of this, if you'll stay with me, that'll explain this. I've always earned a rate of return, tax-free, of at least 5.5% greater than the inflation rate at the time. How do I do that? It's because I link my returns to the things that inflate. When inflation was at 10%, I was earning 15.5% is what I'm saying. So I don't like inflation any more than you do, but it doesn't hurt me because if inflation goes to double digits at 10, I'll earn probably 15 based on history. I can't guarantee that, but it's been true for over 45 years with my favorite instrument, which I call the laser fund, okay? So you link your returns to the things that inflate, so inflation helps you instead of hinders you. So how do we calculate the rate of inflation and the impact of it on our dollars? Here's a formula. Now, if this is intriguing you and you can think of somebody that ought to watch this, share, make a comment, like, but I would love for you to subscribe to this channel. I post an in-depth answer to a financial question almost on a daily basis. I'm passionate about education and empowering you, okay? So here is what we call the rule of 72. If you take the interest rate that you earn on an investment and divide that interest rate into the number 72, it tells you how fast your money will double. So let's say you're earning 5% interest on your money. 5 into 72, your money doubles every 14.4 years. If you're earning 7.2 divided into 72, your money doubles every 10 years. If you're earning 10%, it doubles every 7.2 years. You got it? Well, sort of the reciprocal of that equation is true. So if you could get by on, let's say, $5,000 a month right now, and you are wondering, well, what about inflation? I go, well, what inflation rate should we use? Well, let's say 7.2%, because it's going to be in excess of that, in my opinion. That means the cost of living will double every 10 years. So that means if you can get by on $5,000 a month today, in 10 years, you'll need $10,000 a month. In 20 years, you'll need $20,000 a month to buy the same gallons of gas and loaves of bread, haircuts, golf green fees, prescriptions that you could have bought for $5,000 20 years earlier. What about 10% inflation? Mark my word, we are headed for double-digit inflation because of history. Whenever they print money like they've been printing lately, this is where it goes. So 10% inflation into 72, it doubles every 7.2 years. That means if you could get by on $5,000 a month today, you're going to need $10,000 a month to buy the same gallons of gas, haircuts, and loaves of bread in 7.2 years. In 14.4 years, you're going to need 20 grand to buy the same goods and services that you could buy with $5,000 a month just 15 years earlier. This is what causes people to outlive their money because they have to keep pulling out far, far more money. And not only that, they're pulling it out of IRAs and 401ks, and they're raising taxes. And so you have to take out 50% more in a 33% bracket. You have $1 million nest egg, and it's earning 10%. And so you think you can just pull out 100,000, but you pretty soon need 100,000 to buy what 50,000 used to buy because the cost of living doubled. But to net 100,000, you have to pull out 150,000, pay tax of a third, 50 to net 100. This is what I call the tax and inflation power curve. Those are the two dangers that cause most Americans to outlive their money within 15 years of retiring. So what can you do to protect yourself so you don't outlive your money? So if you're concerned and you agree with me that because of the printing of money, irresponsible government spending, that they've been trying to hold down inflation, but they can't do it forever, we are going to see inflation go to 7, 10%, heaven forbid, even higher. So if the cost of living doubles every 7 to 10 years, which means the purchasing power of your hard-earned dollars gets cut in half every 7 to 10 years, meaning in 15 years or for sure, probably in 20 years. You can only buy 1/4 of what you used to buy because, again, the cost of living has gone up. The purchasing power of the dollar has gone down. What can you do? I mentioned earlier in this episode, what I do is I link my returns I'm getting on my money to the things that inflate. This is a strategy called indexing. Now, in this episode, I cannot explain indexing in detail. I want you to watch other episodes where I teach about indexing, or you can read because I want to gift you a copy of this book. In a nutshell, when you use indexing with my favorite vehicle to accumulate my money tax-free and be able to use it tax-free, and when I die, it transfers tax-free. Nothing else in the Internal Revenue Code does that. And it's not anything new. It's been around for 107 years. It's a sacred tax-free cash cow. And E.F. Hutton, clear back in the 1980s, they weren't even an insurance company, but they're the brainchild behind this instrument. And I call it the Laser Fund because LASER stands for Liquid Asset Safely Earning Returns. It passes liquidity, safety, and rate of return tests with flying colors, okay? Now, I use this instrument for the tax-free accumulation of my money and tax-free income. Every million can generate 60,000, 80,000. Most people get about 100,000 a year if they have $1 million in their laser fund, totally tax-free. If they live to be 120, they just keep getting 100 grand a year. Now, what about inflation? Well, by using indexing, this is indexed universal life insurance contracts. You're linking your returns to whatever the market is doing, the S&P 500, the Dow Jones, the Euro Stock Index, it could be the Russell 2000. Those are the goods and services that are going up in price. Those are the things that are inflating. You're linking your returns to those, but your money is not invested in the market. And people go, what? You need to read and understand this or watch another episode. So it basically allows me to participate when the market goes up, but when the market crashes, which it does every 7 or 8 years, I don't lose. I have averaged 10.07% net cash on cash tax-free rates of return in my laser fund. Some years I've earned 8.2. Some years nothing, but other years as high as 61%. I'm just giving you averages, but it means simply that if you could earn 10 and inflation's at 5, you're earning double inflation rate. But if inflation goes to 10, like back in the 1980s, do you know what I was earning on mine? 15.5%. I've had years where I made 21% when inflation was clear up there. And so I've always believed you want to make sure your money is linked to those things that are inflating, and now you'll be immune from inflation. It will actually help you instead of hinder you. Is this intriguing you? Study this. It's 300 pages. It's called The Laser Fund, my most recent best-selling book. You don't need to pay $20 retail. I'll gift you a copy. To claim your free copy, go to laserfund, laserfund.com, or click below. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost. I'll fire out a hard copy to you. There's also options there if you like to listen and learn or watch and learn. But this will teach you how to diversify and create the foundation for a tax-free retirement. And it's the best hedge against inflation that I've ever seen in my career.